In this session, we're going to talk about volatility, and a lot of that volatility is induced by tariffs. It's certainly not reduced by them. Little slip of the
No.
tongue there. And it does cause panic, which results often in bad decisions with regard to your portfolio. And there is an importance to disciplined investment decision making. And we're going to cover on all of those processes or touch on those items today. My name's Don Creech.
And I'm Perry Sykes, and welcome to the Investor Resources Podcast.
So let's start with the tariffs. And my goodness, this is something that the market does not know how to figure out what to do yet. And it doesn't matter whether it's you individually saying, I have no background, I have absolutely no idea, I didn't take investing in school. Don't feel bad, because the guys who are professionals at JP Morgan and Wells Fargo and Bank of America and Morgan Stanley, they don't agree either on what should be done at this point with your portfolio.
Correct.
If you want to find somebody that agrees with you, you can, and they'll be bears. If you're a bull and you want to find somebody that agrees with you, you can. There are bulls out there. It's just a matter of, what are we going to do with a situation that the market hasn't experienced in 100 years? We haven't had a change in the global trade setup in 100 years. This time is different, and that's a problem for financial analysts. There's no model. There's no model to fall back on.
They hate this. Like they always say, good news, we love it. We know what to do. Bad news, we love it. We know what to do. Total uncertainty, we hate it. We don't know what to do anymore. The playbook's out the window. They don't know which way to go, and that really does account for most of the volatility right now, is uncertainty. And that is the most hated item on Wall Street. They want to every day, whether it's good news or bad news, if things are getting better every day or getting worse every day, that's fine with them. It doesn't matter. They know what to do. When they don't really know what's going on or where this is going to head or end up, especially, that's when they really start to panic. And that's when people, both professional and doing this on their own, start to make mistakes, start to get scared, and they do things they would never do before. And a lot of it's driven by uncertainty.
So basically what you're talking about reminds me of algebra class, where you have X times Y equals Z, and you're supposed to solve the problem. Well, you need to know what X and Y are in order to get to Z. And this is a market where you have X times Y equals Z, and you're supposed to solve it, but nobody knows what the inputs are. Which set of data is reliable? And then you get the administration and the Federal Reserve fighting among one another. Each one of them think they should be in charge.
Yep, that's good. Yeah, that
didn't help.
And like I said, Don, and then it all gets political. And then the guys on Wall Street are like, well, I don't trust this guy anyway in the White House. He said this, and then the next day he said that. So now I don't believe anything he says. So I'm just not going to react. And it becomes a political decision instead of, well, what's he actually doing? And then it becomes, I don't care what he's doing. I'm mad now. So I'm going to do this other thing. And it can get off track. And that's kind of where we are right now. And it's going to stay that way until we get a little clarity and things settle down. President Trump, the entire time, has said, look, this is a negotiation tactic. I'm not putting on tariffs to leave tariffs on. I'm putting on tariffs to get responses quickly and then do something. It's got a bunch of responses, and now we're waiting for the do something part. We're going to see, okay, so where's this going to end up, and what kind of results is he actually going to be able to get? And if those turn out to be very positive, I think we'll do well. We'll be back on track to getting markets back underway again to the upside. If we get more confusion, that's not good, and we don't need any more infighting. But again, that's another one of those things we don't get to control. We just get to watch what's going on and try to deal with the fallout.
So the uncertainty can last for some time, and basically corporations don't know what to do. If they're going to have a tariff, they can plan on that in their cost forecasting and their pricing. If they're not going to have a tariff, or if it's going to be a different amount, if they can onshore, that's a benefit. If maybe, depending on how quickly they can bring production back to the U.S., CEOs need reliable data to build a business plan.
Correct.
And that's necessary for analysts to determine the probability of corporate earnings going up or going down. That information is important for investors to decide whether they want to invest in that company or that sector. So the chaos that's going on right now is going to take a while to work out. And it creates fear, which is tracked in the stock market by volatility. High volatility means generally is associated with a high level of investor fear, and investors close their pocketbook and they won't put money in the market. But if you listen to the advisors on TV or on the social media, they say, well, the market's cheap, and now's the time to buy. But buy what? And
Right.
is it really cheap, or is it going to get cheaper? And
There
that's
you
where
go.
that's where rules come in. Do you have rules? Are you following? Are you keeping the data up to date? And are you following the rules? This will turn around. We just don't know when that turnaround's coming, but rules will give you the warning that the turn has come. It's already happening, and now the odds of getting in are safer than they were if you have no rules and you're not paying attention to trends and data.
Absolutely. And that's why we are so focused on being adaptable and being able to change when the market changes. If you're glued to that diversified pie chart, which is just looking at historical returns, and everything you do is anchored to a 50-year, 80-year history in the market, it's really got nothing to do with what's going on in the market today. Things change rapidly and they change drastically. And to just look at it and say, well, I'm just going to wait for another 20, 30 years, and this was probably going to work out for me, which is what your broker is going to call you on the phone to tell you. Don't panic. Everything's going to be fine at some point. Instead of saying, you know what, we need to rotate out of this. We need to do something else for now. Or we may even need to raise some cash and wait for the smoke to settle before we even know where to invest. And to us, that's a much more logical solution than saying, well, just sit on this and let the market roll over our returns, instead of saying everything's moving against us, let's get out of the way momentarily. And that's the key. It's never in all the time or out all the time. It's what are we doing right now, and can we find a logical place to put capital to work? And if not, let's raise some cash and wait. And that's a better decision than just waiting for the market, because like you said, Don, you have no idea when that next change is going to occur.
One of the major indications of a bear market in the making is when on the S&P 500, typically the 50-day moving average falls below the 200-day moving average. That's called the death cross.
Good name.
Yeah. And it goes back to the old adage that nothing good happens below the 200 moving average. And when the 50 drops below that, that's just compounds the problem. But it doesn't necessarily mean the world is coming to an end. That's the wrong conclusion. It just means times are a little bit more difficult, and you need to pay a little more attention than you might have when everything was going up and you could smell the roses every day with your portfolio's profitability. This time is different. It's a different season. But the fact that the death cross has occurred in the S&P is not a crisis. When we look at how the market has performed after the S&P 500 death cross since 1950, 54% of the time, 1 week later, it's still positive. Well, at this point, 1 week later, it's not positive. So this time's different. But if we go out a year, 70% of the time after the death cross on the S&P 500, the market's positive. Returns are positive. So there's a point in time between now and the end of the year where it's going to make a lot of sense to commit what cash you have set aside, generated from sales, or accumulated because you've been afraid to buy anything. And that fear is common right now. It's keeping most retail investors on the sidelines. And as it turns out, that is a prudent call. It's a prudent asset allocation in this decision making time. But the question is, will that fear keep you from investing the cash when the tide turns? And how will you know that it's turned? That's where rules and data and discipline are your benefactors. They keep
Absolutely.
you from making big
Especially,
mistakes.
Especially the discipline, because it's easy to take a look at trends and returns and say, you know what, this market's turned. I think it's time to get back in. But you have to have the discipline to actually do that. And when you do it, it never feels good. It's never like, yeah, this is probably a good idea. It's like things are still dicey out there. I don't like the way things look. This is very uncomfortable. And that's probably the best time to make that move. Once you've identified that trend appears to have changed, and no one knows for sure, that's that illusion of control people get over the market. I think I know exactly when to do this. No one knows exactly when to do anything in the market. You just get the preponderance of evidence that says, I think now's a good time to roll some cash back into the market. And then you watch, did this work or not? And you react to that again. But you have to be willing to make that move and say, hey, this market's been terrible, but now it's time to get back in. And you have to be willing to make that move.
That reminds me of another phone call, Perry. This happened about a month ago. The market had been down some from January, and I have a call from not a client, but an individual who's on our mailing list. And he said, well, the market's really dropped here, and I really feel like this is a good time to enter the market with his federal retirement plan. And
gotcha.
I said, I don't think you're making a good decision here, because what we see as data is this is not ready to bottom out. Right. I had no idea where it was going to go from there.
Sure.
But we're paying attention to data and trends, and we have signals that say this could be changing. You got to pay a little more attention here. And it's kind of like an airline coming into the airport, and the pilot sees another plane coming crosswise to him. He's going to say, it's time to make another decision. It may have looked all clear a little bit ago, but not so much right now. We better take a hard left.
There you go.
Anyway, I have no idea if the individual put his money in, but it has just severely dropped since he thought it had dropped enough. That's where your emotions and your gut can get you into a lot of trouble. That's why data, discipline to make decisions are essential for what you're doing. If you want to talk about that, you can give us a call. Contact information is coming right up. Thanks for staying with us. Have a great week.